All right. So welcome back. Excuse me. Um, so Yunshu Shao was the person who sent the email about the sign of the intrinsic value and the numerical moneyness. So that was a very good question. And thanks for asking. And it seems that you've understood the point, right? So in terms of
Yeah,
okay.
yeah, I understand.
It's the value versus intrinsic value. It has that hockey stick shape. All right, now we're going to, so far we have taken the very, very important valuable data set of CBOE, which is a snapshot data set. Now we're going to look at historical data and look at a lot more analyses that we can do with that. I'm going to just introduce you to and do some very basic calculations with the option metrics data set today. We will need to do some of the more option related eccentricities a little bit today and next week as well. All right, everybody please get on your internet browser. Okay, in this case, when we're done with CBOE, we're not going to use CBOE anymore. Now let's use words. Can you see my words? This is the login things that we have done a number of times in the past. Shuohua, can you see it?
Yeah, I can see that.
Okay. So previously we have just gone to CRISP. Today, go to Get Data, click on Option Metrics. Rundan, can you see it? Gail, can you see it?
Yes, I can see it.
Okay, then click on IVDB US, click on Options. Click on Option Prices. The latest we have data for, one of the problems with these finance data sets, well, one of the great things about working in finance is the data sets that we get are so clean. The historical data are so fabulously cleaned up. I mean, for people like me who work with huge data sets, one of the reasons I remember I was telling you to please put your submissions in a particular format, because otherwise automation is impossible. Cleaning up data sets, which is what I ended up having to do, is extremely painful, time consuming, and brings in errors. Whereas when we look at the historical data sets in finance, they are perfectly cleaned, and so we can do all kinds of automation. Problem is, it takes a while for the data sets to be cleaned up. So right now for option metrics data, we only have data for up to middle of last year. So almost a year old. So clearly nothing about the Great Secession is going to show up anywhere in option metrics. Unfortunately, that's what it is. So you can see where all these things that we talked about, there are these snapshot data sets that, like CBOE, Yahoo Finance, Google Finance, Wall Street Journal. They're great. They have their roles, especially when you're doing some quick and dirty work. But if you want to do hardcore empirical analyses, when you want to make sure that the data are are correct in all ways, and you want to be able to do like three-stage least squares, worry about endogeneity and all those things that you've learned in econometrics, then you have to use these more cleaned up historical data, in particular, for instance, option metrics. So let's say we take 2019 06 15, the last half of June. Pick anything you want, follow along with me, okay? So I'm going to, let's say, pick ticker, let's say Tesla, okay? Pick what you want and follow along with me. All of this I will post on Blackboard. A lot of them are already posted on Blackboard. So no need to take photographs or anything. You just follow along. Do it with me as I go along. Okay, because this is the kind of thing, it is absolutely critical that somebody who is coming out of an advanced course in financial economics needs to have under their belt. If you were to go and sit at the options trading desk of Goldman Sachs, which I'm hoping you would be able to do, hope that's where, if that's what you want to do, then this is the kind of thing you should be able to sit down and do right away. All right, so this is a skill you need to have under your belt. You need to know where the data live. You need to know how the data work, what you can do with the data, what you cannot do with the data. And so that will be something that you are tested on in your final exam as well. All right, I will post a sample final exam, and you will see this is the kind of thing I will test you on as well. So follow along. If you have any questions, stop me. Shing, where are you?
Yeah, I'm here.
Yeah, Shing always has fabulous questions. So Shing, follow along, and if you in particular run into anything, stop me, okay?
Okay, thanks.
You need to come out of this course knowing option metrics. There is no other way, okay? If you're doing more big data kind of work that I do, you would download entire data sets. Instead of doing it for one stock, you download it for all stocks that are traded on markets. You would do it for, the entire data sets from 1996 that in the book that I have published. That's what I've done, and so on. All right. So let's say for Tesla, if you want to do it for like the S&P 500 index, SPX, which is what we were doing for the data that we looked at from the CBOE, you could do that as well. Follow along. All right. So let's say for Tesla, all right, because we are using Excel, and we already saw earlier that it's actually the option chain, which is very good for a visual, where you have call options on the left and put options on the right. Is very good for a visual, but it's not that great for the actual analyses. As we saw, we had to kind of go back, do corrections here and there, and that's just not and that's purely because we are using Excel. If we were using some more sophisticated data processing software like SAS that I do, you would be able to do all of that in SAS without just, it's a one-line code. But in our case, when we're doing it Excel, it's better to do it separately. So download call options separately, download put options separately, instead of trying to download one and separate them out. As I said, if you were using SAS, it's a one-line code. In Excel, it's a filter, cut and paste. It's a problem. You can, anytime there are more steps in an empirical exercise, you bring in the possibility of error. Okay, which is why automation is so critical in when you're doing data work. Okay, everybody with me? All right. Okay. Now, I'm downloading data for Tesla. Given what I told you earlier in this class, what exercise style should we say? Tesla, remember, is an American equity. Tesla options on Tesla equity are traded on American exchanges. What are they traded as? What kinds of options are available on the market?
I think it's American.
Who is this? I can't see you.
And this is Chen Lu.
Chen Lu? Okay, exactly. All American individual equities are only sold as American options. Believe me, and this is something I know because I have actually checked the data. I've gone through, not only have I relied on other people's research, other people's commentary, what people have said in press statements, I've actually trawled through the data, and I can tell you for sure that individual equities are indeed only sold as American options. Okay, Chen Lu, what if instead of Tesla, it were the S&P 500 index?
Then I think it's European.
Correct.
Right.
Excellent. Now, Chen Lu, to get some, you're rapidly approaching the territory of getting over 100% in class participation. What is the difference between the two?
Oh my God, I'm sorry. I'm sorry. Can you repeat it?
Sure. Don't get nervous, nothing to get nervous about. You just mentioned very correctly that for Tesla, options on Tesla shares are always American options. Options on the S&P 500 index are European options.
Yeah.
What's the difference between the two?
In America, like you can exercise the option like whenever you can, but like a European, no, you can only exercise that on that particular day, the expired day.
Right. Well, what you said, it's you can an American option you can exercise anytime like before. Right.
Yeah.
Very good, Chen Lu. Everybody got that answer? Okay, we're all okay. So ticker, Tesla, American. To be safe, you can put both. You know, you won't get any European. Security type, it's equity because you have already said it is for Tesla. Okay, what are the things we need to download? It's lots of data, but remember the number of options it becomes, because there are many, on even one security, there are many types of options that are sold on this one equity on one day. Okay, so there are many observations for each day. So we need to reduce the number of fields. Okay, exercise style, we all know it will be American, but let's put it that anyway. We need the call put flag. We need the expiration date. We need the ticker to make sure we're getting it right. You know, SIC codes, we really, that's not part of our object. We need the data for a different analysis. For at this point, we are simply doing option valuations, option prices. That's the objective. So we don't need index flat, class designator. We need the highest closing bid and the lowest closing ask. That is to say, we need the best, those are the best bid and the best ask, because that is the best way of getting the closing price of a particular set of options on a particular security on a particular day is the midpoint of the bid and the ask, as we saw earlier. Okay, so clearly we need the bid and the ask. Okay, volume, because if something has traded zero volume, it's not, if traded zero, it's not as informative. But so we need the volume. Whether we keep them or not, that's something we'll do later on when we talk about implied volatility and calculating Black-Scholes. The volume becomes important because it turns out that the traded price is important for certain kinds of options than it is for others. Okay, the Black-Scholes turns out to hold better for heavily traded options. Those are things that we'll see. Okay, strike price times 1,000. Obviously, we need the strike price. Otherwise, how are we going to do any of this stuff? Implied volatility is something we'll see is very important from options, because remember, I started this lecture today by saying options are where sophisticated investors work at. So in order to understand what the volatility of a market is, if you can calculate that behavior, calculate that volatility based on the behavior of sophisticated investors, that is a very good measure of the actual volatility of the market, instead of what people are saying. Because what people say the volatility is, it's, somebody's opinion is worth nothing. The only thing that matters is what their behavior actually shows, right? So that's why the implied volatility, and we will actually show how to calculate implied volatility. But the great thing is, we don't actually have to go around calculating implied volatility all the time, because option metrics actually provides this calculation of implied volatility. So does CBOE. The calculation of implied volatility has become very standard, so we don't actually have to go around calculating it all the time. But you need to know how it is calculated, which is why we will spend a little bit of time just doing that. Okay, it's pretty, the concept is straightforward, and we will do a little bit of that to make sure we understand. Okay, so we will download it as an Excel spreadsheet. No need to zip it. We'll use the American date format. Submit query. Okay, have you been able to download your files? Rundan, have you downloaded?
I'm downloaded now, but I'm waiting for it.
Okay, what stock what underlying security did you use? Did you select?
I'm sorry, but I use the same as you.
Okay, that's absolutely fine. Yunshu, what did you use?
I use the same one as you.
Okay. Sheng?
I use the Tesla as well.
Okay. Chenlu, what did you use?
Sorry, I'm using the Tesla as well.
Okay, Gail, what did you use? Okay, I actually read your lips. I couldn't hear you. You said you use Tesla as well, right? I could read your lips. Oh, this is awesome. I've acquired a new skill as a result of doing Zoom. I can read people's lips now. Sure, Huama, what underlying did you use?
Tesla as well.
Okay, that's fine. Did anybody use something else? Which is absolutely good. First time, go along with me, then you can play around on your own. Yeah, that's actually a smart move. Shenyang, what did you use?
I use the same one.
Okay, Jiakang?
Yeah, I use them.
Okay.
Mm-hmm.
Zhongwan, Yang, what did you use?
Tesla.
Okay. All right. Did somebody use something other than Tesla?
I picked the General Electric.
Sorry?
I choose General Electric.
All right. Sorry, what's your name? I can't hear you.
Hongsheng.
Hongsheng. Oh yeah, your thing's marked up. Well done, Hongsheng. So after this is done, I'll ask you to show your screen. Okay, be ready for it. All right. So make sure you can save it. Tesla. Options 2019 06 15 to 2019 06 30. Okay, can you see my Tesla diagram? The chart? Sorry, the Excel spreadsheet. All right, so I'm going to just rename it as options data. Right. Format column width 15. I really don't like these colored fills. No fills. Automatic. Okay, so date of this price, expiration date, we have just, okay, these are options data for call prices. So rename them for call prices. All right, strike price of the option times 1,000. So we need to actually have the strike price, which is equal to this divided by 1,000. Okay, this is the best bid. This is the best ask. We need to create a price of the option, which is the mid bid ask. Okay, unique ID for the option contract. We really don't need it. Ticker symbol, make sure we have everything Tesla, as long as we got everything right. That's just to make sure we got everything right. That's otherwise just clutters it. Index flag clutters it. Description issuing, make sure it is Tesla. Good. Once it is done, let's get rid of it. Okay, is it American or European? It's all American. As we saw, not surprising at all. All right, the strike price, highest bid, lowest bid, mid bid ask, these are all dollars. So let's make sure we have them in dollars. The volume is in numbers with no decimals, but with the commas. We'll have that. Okay. What is missing? There is one very important. Okay. Another thing is this days to maturity or length of the option is equal to the expiration date minus today's date, or the date of the price, not today's date. Okay. There are even some zeros, and that's simply the fact that a mature, because remember, option metrics is daily data. So we are getting the data as of the end of the day. Everything that happened in that day is summarized, whereas the snapshot data that we saw from CBOE is intraday. That happens as of a particular time, right? So that's a difference between snapshot. So you can definitely see, sometimes you can see zero data, and you have 732 days. That's 2 years. So you can have, so you have options that have, that we have data for options with a very large range of the days to maturity. What is missing? What would we like before we do anything else with this?
Intrinsic value.
Say that again.
Intrinsic value.
The interest rate.
No, the intrinsic value.
Okay, the intrinsic value. Good. How are you going to calculate the intrinsic value?
We use for call, we use the underlying price minus the strike price.
Okay. Where do you have the underlying price? Where's the underlying? Which column is the underlying price?
I don't see it.
Yeah, it's not there. So what are we going to do? We're going to download. We're going to do another download. This time, not from option metrics, but from our favorite CRISP data. Go to CRISP, stock security files, daily stock files. We can download it. We only need it for, what did we do? 2019, June 15th to 2019.
Sorry, Professor, that's not showing that's not sharing the screen on the step of downloading.
Okay.
Now.
Okay. So click on CRISP like we have done before many times. Go to stock security file. We need daily data for Facebook underlying security prices. The data, the range is 2019 06/15 to 2019 06/30. Ticker Tesla. All we need is price, right? I like putting ticker to make sure we got it right. Okay, that's because sometimes we're not quite sure. Ticker, price, that's all we need, right? Excel spreadsheet, no need to zip. That's a very tiny database that will come up in no time whatsoever. All right. So we download it. Let's say we said Tesla equities 2019 06/15 to 2019 06/30. Okay. All right. Now I'm going to change the sharing. So I'm opening up the Tesla equities data. I'll share it when that opens up. So please open up that equity price data because we need the underlying price. Got it? Kehan, can you see it? Can you see my underlying data?
Yes.
All right. So let's name this Tesla underlying prices. Okay. What we need to do is to move a copy of this to the options data. Can you see the options data? Hanshu, can you see my options data for call prices for Tesla?
Yes, I can see.
Okay, and the spreadsheet next to it is with the price of Tesla underlying for a bunch of dates, the second half of June 2019. Yes.
No, we can only see the underlying price.
Okay.
Yeah.
You can see the underlying price.
We don't see
Yes.
the option metric.
Okay, but can you see the underlying price? All right. So I'm converting those into dollar numbers. Okay, I'm going to move back to the options data for call prices. Can you see it now?
No.
No.
How about now?
Yes.
Yeah.
Okay.
Yeah.
All right. So over there on the next spreadsheet, I've moved the equity price data set into the as a new spreadsheet there. Can you see that?
Yeah.
Okay. Now over here, so that we can combine right next to the strike price, let's put in a new column, which is so underlying price. So underlying price is the price of Tesla equity on the date of the calculation. So we need the price of Tesla equity on June 17th, 2019, which is A2. Where are you looking it up from? From this, from the next spreadsheet, columns B, C, D. Which column? 1, 2, 3, comma, false. So the underlying price. Now, do you see why it is absolutely wrong to just stack data sets against each other? Because you will get completely meaningless results. How can you stack things up like here? You couldn't. It would make absolutely no sense. Because what you need here is in cell G2, you need the price of Tesla equity on June 17th, 2019. So you have to merge these databases. You have to actually do a proper merge. Just stacking them against each other, copying and pasting is just not going to work. So you lost people who did copying and pasting or stacking of data sets in the midterm, lost a lot of points. Well, lost some points. You will lose pretty close to everything if you do another copy and paste and stacking in the final exam, because it's absolutely wrong. All right, you need to properly merge. You need to do proper data work at a if you're in an advanced graduate course at a top university. All right, so these are the underlying prices on those particular dates. All right, so let's just make sure we're getting it right. So these are the dates that we have the calculations for. Remember historical data. Let's pick a date. Let's say 6/28/2019. What is the underlying price? $223.460. Is that 46 cents? Yes, 223.46. That is the underlying price. So we got our calculation. We at least did a quick check. So this is what we are getting. So we have the strike price, we have the underlying price, and we have the mid bid ask, which is the price. This H and I, we don't need those. So let's just move it out of there. So we need the strike price, we need the underlying price, and the mid bid ask, remember, is that's a price. So price, underlying price, strike price. They're the three different prices that are relevant for an option. So let's say we now calculate the intrinsic value. So do the numerical moneyness. So remember, these are call options. That is to say, you have the right but not the obligation to buy at the strike price. So if you can buy at $10, the first here, this thing here says what is row 2? Row 2 is an option which allows you, which gives you the right but not the obligation to buy Tesla security anytime between 6/17/2019 and its expiry on 6/21/2019. Anytime in that time period, it gives you the right but not the obligation to buy one share of Tesla equity at a price of $10. All right. Clearly, as you can see, it's quite a bit lower than what it is. So it's valuable if the price stays above $10. The probability of, and later on we'll see in Black-Scholes, everything, it's all a function. That's all this is trying to calculate, is the probability that the underlying the stock price, that stochastic process will actually stay above that strike price. And that's a function, for instance, of the volatility. The higher the volatility of a stock, the more the chances of the price actually going down to that. So the numerical moneyness is equal to underlying price minus strike price. In this case, it is positive. Let's do another thing, which we do, it's normalized moneyness, which is equal to numerical moneyness divided by underlying price, but this is a percentage. And what are the ranges we are seeing? If the normalized moneyness is negative, that means it is out of the money. If it is positive, it means it's in the money. And if it is close to zero, so for instance, if we say somewhere, if it is between -1% and 1%, then we'll say it is at the money. So we can do these calculations. If you want to do a filter lying between, let's just quickly do that. Do a custom filter. It is greater than -1 or less than 1. Sorry, greater than -1 and less than -1. What the heck happened here? they're all in percentages, of course. Greater than negative 1%, less than 1%. All right. So here, the normalized moneyness is between negative 1% and positive 1%. This is where it is practically at the money. And this we'll find this is those options for which the market data are actually quite reliable. These options that we see where the normalized moneyness is very close to 0, those are the options that we say are near the money or at the money. And that's what gives us these calculations. Similarly, you can do these download and do very similar calculations for the options data for put prices and do all these calculations, which we will do a little more of next week as well. All of this will be posted on Blackboard. A lot of it is already there. I'll post anything else that we have done today. And let's move on to a couple more things that I want to discuss today before we're out of time. All right. So this here is for Facebook data for the last week of 2017 between Christmas and New Year. You can see these are the underlying prices. Sorry, who was it who had mentioned the very good question that when we are evaluating options, we absolutely have to, in order to talk about payoff, we have to take into account the price that you're paying for the option. So we are now going to make sure we get the payoff diagram. We're doing the payoff diagrams, and the price of the option will be included in that payoff diagram. So Yunshu, was that your question?
No, Mavis.
Mavis, about
Yes.
the payoffs. Yes?
Yeah.
Are you there?
And yes, I'm here.
Okay.
Sorry, the internet is not ideal.
Yeah, it's not ideal, is it? But
Yeah, but
we'll manage.
I will
We're
be home,
managing,
like,
right?
soon.
We're managing.
Yeah. I'll be home soon.
Yes.
Like
And if you
before
have any
next
questions,
class.
Mavis, if you want to talk right after this class, just let me know, okay?
Okay, yeah, thank you.
It's absolutely critical to me that every single one of you come out of this class knowing, you know, how to work with all these data sets, knowing options, knowing what face values are, what intrinsic values are, what put call parity is. I want you to understand financial economics. And so getting your hands dirty with all of these things is critical. And I need 100% success rate. Every one of you needs to understand what's going on. So, so talk to me, okay?
Yeah,
Everybody.
sure.
Okay. So these are the underlying and
excuse me.
yes. Who is this?
Are
I
we
can.
supposed to, Mavis? Are we supposed to see your screen right now? Because all we can see is your face.
And you're saying my face is not good enough? Is that what you're saying, Mavis?
No,
Come on. I'm a model. I'm a model. I mean, you know, people.
Yeah. Of course you
so
are.
good looking. Come on. Yeah.
Yeah. Sure.
Oh, I needed that. That was good. All right. Can you see this? Can you see the Excel file now? Gail, you're smiling.
Yeah.
You can see the file now. Yes. Okay.
Yeah.
Thanks. So the underlying. So make sure we're going from the right to the left. The underlying data, the price data for the underlying security. These are the data. Remember, one of the things that I mentioned, as much as we can, we are going to do everything with actual real data. So here I'm going to do the payoff diagrams for options, and we're going to do them with actual data. All right. So these are from option metrics. We have calculated, we downloaded the data for the last week of 2017. Done exactly what I did earlier, strike price times 1,000 divided by 1,000 to get the strike price. We get the underlying prices, and then we get the options. Similarly, for the call prices, we get the mid bid ask, which are the prices that you're paying for the options, and then the payoff diagrams is okay. Let me just go to the right of this. The net payoff then is equal to the H2, which is the payoff to the long call, minus L2, which is the price that you're paying. What is the payoff to the long call to maturity? So what is the underlying price to, first of all, let's say this is, the strike price is 175 that we are considering, okay? At maturity, let's take a possibility that it can take price values between 170 and 180, and let's just consider all of those possibilities. Okay, what happens if the price at maturity is $170? This is a call option. It gives you the right, but not the obligation to buy at $175 when the underlying price is 170. What are you going to do?
We don't
Gail.
exercise the option.
So who was that?
Mavis again.
All right, Mavis, good. All right, so you do not exercise that option, because why would you pay buy at 175 from the option through the option contract when you can buy from the market at a cheaper price of $170? So you will not exercise the option. The payoff is 0. So at date of maturity, it's OTM, as in out of the money. All right. Let's go to the bottom. Let's say, on the other hand, at maturity, it is $180. Okay, Gail, what happens if 3 days later at maturity, the price is $180? First of all, at date of maturity, so remember, this call option gives you the right, but not the obligation, to buy at $175. But
I would exercise my right to buy it.
you will exercise your right to buy it, exactly. And how much money do you make?
$5.
Right, that's $180 minus $175. So because the price at the market is $180, the call option gives you the right, but not the obligation to buy at a cheaper price. You will buy it at the cheaper price and sell it or hold it, doesn't matter, at the higher price, and you make a profit of $5. If now at this, if the underlying price at maturity is equal to 175, then Hai Hua. What are you going to do? Hai Hua, are you there? Shenyang, what are you going to do? Yu Cheng,
Yes.
what are you going to do if the underlying price at maturity is $175?
I think I will the I will own I will earn zero in the price at $175.
So what's your decision?
Just neutral.
Sorry, I'm not sure I understand what that means.
Just my choice is
Choice in the question is, do you exercise your option or do you let the option expire? What do you do?
I think I will exercise the option.
Why?
Yes, since I will since under this price I will not get any lost.
Okay. Then why not let it lapse?
Uh,
Why not let it expire? Okay, so the answer here is you're indifferent between exercising the option or letting it expire. In either case, you make zero. The payoff to long call at maturity when the option is at the money at maturity is exactly $0. So H, the column H gives you the payoff to call at maturity by just for different prices that can eventuate at maturity by calculating these payoffs. So that gives you, and then the mid bid ask is something that we look at the data and see what the mid bid ask is the price that you pay for that particular call option, which was with the strike price of $175 on 12/26/2017 with an expiry date 3 years into the future. So you plot this net payoff, which is equal to payoff to long call minus the price that you pay, which gives you the net payoff, which is equal to H2 minus L2, payoff to long call minus the price. So if you do the payoff diagram, this here is the famous payoff diagram for a long call option. That the blue line is the payoff payoff. And because you have to buy the option, you actually have to pay, as opposed to forwards and futures where you did not have to pay up front, but you had the obligation. In option for options, because you have that optionality, you have the right but not the obligation, so you have to pay up front, and what you pay is exactly the option premium or the option price, and that is subtracted from this. So in exactly the same way, we calculate the net payoff to a long put, and it looks exactly the same way. The blue line is the payoff to long put at maturity, and because you have to pay to buy that option, it is a subtraction from that. So that is the net payoff. The orange line is below that. Let's close this, and I'm going to now open a file which shows these calculations for a short payoff diagram. So 16B, which is the short payoff diagram. What's going on here? Can you see my screen? Can you see the Excel spreadsheet, the short payoff?
Professor, I have a question, Professor.
Yes. Could identify yourself, please?
Yeah, it's Botal.
That's Botal.
So like why the payoff is 0 when underlying price is 174. So it's a data on the H6. So why the payoff is 0? Yeah, H6.
Yes.
The payoff. Yeah. So why the payoff is 0? Because I think it should be -1. It should be a pass. Okay. Okay. Sorry. Yeah.
No, there is an error. You're absolutely right. In this case, if the strike price is 175, you remember you are in this case, you have the short position, right?
Yeah, yeah.
So the long position, okay, Bota, you've definitely acquired some extra points on class participation. Thanks for pointing it out. So if the payoff at maturity is 174, then the long side of this call option has the right but not the obligation to buy at $175, but can buy at 174 at maturity, so will not exercise the option. So it is 0, okay, with H6. With H7, it's also 0. It's only when you get to H8 that you exercise the option. So you as the short player will have to come up with that payment. Yeah, okay, so it is correct. But thank you very much for forcing me to think it through. Thank you. Okay, is everybody clear on this?
Yes.
Okay. Okay, these are the ATM. They're being called ATM because they're very close. They're at the money. Remember, we talked about this. It's when it is when it is close to 0, we still call them at the money. So that's why they're still being called at the money, but they're not exactly 0. All right, so these are, excuse me, the mid bid ask is what the price was for this particular option. Now, as the short side of this particular option, you're the one who sold it, so you actually made this money. You were compensated this money. So this L2 is something you got paid. So then your payoff to the short call of you got the payoff was H2, but you got paid the price, the option premium, which was that mid bid ask. So the net payoff equals H2 plus L2. So these are these prices. So when you plot them, the payoff diagram actually looks as follows. The blue, which is the payoff to short call to maturity, which is the clearly in an option situation, it's a zero-sum game. So the blue line is what is the payoff onto the short side of the contract, and the net payoff is actually higher than that, and the difference being the price of that particular option as option given to us by option metrics data. Similarly, we have calculated the payoff. So the underlying price, the strike price, gives you the payoff to the short put at maturity. The mid bid ask is the price that was paid for that option contract given to us by option metrics data. So that amount, the L2, is added on to the net, to the payoff to the short position to get the net payoff, because the seller of the option, the writer of the option contract, gets paid that. So when we do the payoff diagram, it is with the blue line being the payoff to the short put at maturity. The orange line is the net payoff, the difference between the two being the option price, also known as the option premium. Okay, let's stop now. I'll stick around for a little bit longer and answer if any questions that you might have. We can try to meet up later on in the week as well. I cannot emphasize enough that you really need to be extremely comfortable with options, okay? But these are absolutely critical. They are very, very important in modern finance, in risk management. Even if you don't end up working in finance, it will still be very, very important for you to be able to understand and articulate and put up graphs of these payoff diagrams and various other situations that you might find yourselves in. All right. So I will stop now and stick around for anybody who might have more questions. I'm going to stop.